the CPI is a manufactured index. It is widely believed, and I think the fact that a falsehood is widely believed is the access to an opportunity. The CPI does not measure the deterioration of the purchasing power of the US dollar. It is an index that is predicated on the prices hedonistically adjusted of a carefully selected range of goods and services. You will note that when they report core inflation, that doesn't include the so-called volatiles, food and fuel. Any index that doesn't include lunch is of no use to me personally. But a bigger fault in the index is that it doesn't include the cost of tax or government. I've said before on your show, if I didn't have to pay the tax, I wouldn't bitch quite so much about the index. But I would ask your listeners to apply some common sense to the CPI. Look at the basket of goods and services that they actually rely on. By the way, I'm not suggesting the government is a service, but let's add it back into the equation because you do have to pay for it. I would suspect that if your listeners took the period, say, 2020 to 2024, or any relevant period, and they looked at the price of, as an example, home heating, or gasoline, or groceries, or healthcare, or health insurance, or home mortgages, which have doubled in 4 years, that they would find that inflation, measured as I would describe it by the deterioration in purchasing power of their savings and their salaries, has been much closer to 7.5 and 8 than it is to 2.5 or 3. And I think a discussion needs to begin with a gauge of inflation that has to do with the living experience of your listeners, not a set of statistics conjured up by the Congressional Budget Office. I think that's very important. The work that's done by Shadow Stats, which measures inflation using the same metrics that inflation was measured by in the 1960s and 1970s, would suggest that annual inflation is worse than I describe it. That the deterioration of the purchasing power of the dollar, measured by historic metrics, is actually proceeding at more like 10 or 12%. I prefer to use 7.5% because that conforms more directly with the very crude measures of the deterioration of the purchasing power of my own savings. But irrespective of which number you use, I think it's important to understand that the 2.7 number is fiction. It has no relation to your listeners. And I think that leads into a discussion in terms of what we do about it of two topics. The first is that most people don't have enough private savings. Most people, I think, have been living beyond their means. Most people, I think, have their expectation of the future governed by their experience over the last 40 years, which saw declining real interest rates. And I don't think the people need to go, or should, curl up in the corner in fetal condition and say, you know what, I don't stand a chance. That doesn't work. But I do think that people need to maintain more liquidity, even though that liquidity costs them purchasing power. I think, too, that anybody who doesn't own physical gold is making a mistake. You don't have to own a lot. Traditionally, when gold performs, it performs so well that as insurance, a small premium buys a lot of coverage. But I personally don't see a circumstance where the deterioration in the purchasing power of the US dollar on an absolute basis, not relative to other currencies, doesn't increase. And in that circumstance, history suggests that a prudent accumulation of gold is on order. In the very near term, on the gold theme, I think what we've seen is relative strength in the US dollar relative to other currencies, and I think that continues. I think the US dollar is, to quote Doug Casey, the prettiest mare in the slaughterhouse when you compare it to the euro, the yen, the Canadian dollar, the Australian dollar. It's on an absolute basis, US dollar savings for US investors, that it becomes problematic. I think we saw softness in gold as a consequence of investor confidence in the U.S. dollar with the Trump election. And I think that you've begun to see that euphoria retreat from the trade. I think you need to measure it in the longer term. I think one of the problems that gold bugs have is that they remember the period early 1976 to 1981, where the gold price went up sixfold or sevenfold in 5 years. From my viewpoint, I'm not looking at gold as a way to enjoy capital gains. I'm looking at gold as a way to maintain my purchasing power. So for me, when people say, when is gold going to move? I say, I think it's going to move beginning in the year 2000. In 2000, it was $253 an ounce. Now it's $2,700. That's 8.5% compounded for 24 years. I don't measure it in weeks or months. I'm old enough to remember in the decade of the 70s when the perception of inflation lagged the reality of inflation for 4 or 5 years. The writing was on the wall in terms of the deterioration of the purchasing power of the US dollar beginning in 1967. But the writing on the wall didn't translate into consumer action until 1972. 5 years or 6 years after the problem had been identified. I think what happened then is, and I'm making this up, by the way, I'm a credit guy, not an economist, certainly not a behavioral psychologist, but the period 1946 to 2067 was a pretty benign time. You know, the end of World War II, the lowering of interest rates, US dollar hegemony on a global basis, the nifty 50, people were trained to buy the dips. I think we've been through the same period in 1982 to 2022, a 40-year period of really benign economic climate. And I think people's expectations of the future were set by their experience in the past. I don't think the world's going to hell in a handbasket, but I think that the period we have in front of us for the next 10 or 15 years is substantially less benign than what we've existed in for the last 40 years. Beginning about 8 months ago, you began to see retail participation in the gold market. Prior to that, for 2 years, all the strength in the gold market was central bank buying. If you look at inflows into ETFs, retail participation in the gold market didn't begin until 8 months ago. Over the last 2 months, you've seen retail dishoarding in the gold ETFs, a flow of funds out, not in. But you haven't seen any cessation of central bank buying. So you saw a transfer of gold holdings from European and North American retail holders to non-US central banks, which is to say the buyer that supported gold for the last 2.5 years has stepped back in the market, including the Chinese. What I think you're going to see next week is that the exodus of retail holders of gold, as measured by funds flows into the ETFs, will have turned around too. It may not be positive, it may be neutral, but I think that what you're seeing is that retail disintermediation out of gold has ended, while continued central bank buying of gold will continue to take the quote higher. We think gold is misunderstood. Certainly among your listeners, there is an understanding of gold. But when you look at the investing public at large, what you understand is that precious metals and precious metals related securities comprise about 0.5% of the total savings and investment assets in the United States. That's down from a 4-decade mean of 2%. And what we'd like to do is do a several-part series on gold. The first boot camp will really be a discussion of the historical role of gold and a discussion of gold's fundamentals and how various gold markets work in a macro sense. The physical market, the institutional physical market, the market for gold surrogates, like the physical ETFs, the physical certificates, the pros and cons of each approach to investing in gold. and a general discussion of the relation between gold investment asset classes, high quality gold equities, low quality gold equities. Give people an overview of how you participate in the gold market so that we give people the fundamental knowledge that we need at the rural classroom to make them much more focused, much more educated participants. My prognosis for silver has more to do with my experience, my observation. I don't, and I don't know anybody who does, really truly understand the silver market in terms of the why. I've been trying for 45 years. But what I do know how to do is observe. And my observation tells me that precious metals bull markets are led by gold. And when the generalist investor begins to be attracted to the precious metals narrative, normally because of the momentum established by gold, when that generalist investor comes into the metals market, leadership in the market transfers from gold to silver. So that transfer seems to take place sort of halfway through a bull market, and we haven't seen the transfer come to silver yet. And I don't know why the transfer does. I assume because of the reputation that silver has for more volatility, which attracts the greed buyer, and also for the lower unit cost, which attracts retail buying in emerging and frontier markets from holders who are unable to store wealth in gold. As I say, I don't know why it happens. I just know that it happens. The last to move traditionally have been the higher quality silver equities. And my observation has been that there is not enough market cap in that category to stand the inflow of generalist money when it happens. So the upside that occurs in the higher quality silver stocks is absolutely insane.